Hi, welcome to this video today, which is all about Forex technical trading strategies. Just want to go through the ones that work in today's markets. Now, when I say today's markets, the ones that work, if you go back just to the 80s when I first started trading, technical trading, it was much easier to make money than it is today due to changes in structure of the market, which I want to go through. Now, in terms of technical trading, three broad ways of trading the markets: be a day trader, you can be a swing trader, or you could be a long-term trend follower. Now, which is the best way to trade in terms of technical trading? It's undoubtedly being a swing trader, catching moves that will last for normally a few days. So I'm going to explain why that is the best way to trade the markets for technical analysis, and you'll see exactly why when I go through how the market structure has changed. Let's just go to a storyboard and review the points in more detail. All right, let's have a look at how the markets have changed over the years and how successful trading strategies that are technically based have changed. Now, put the time periods, the three broad time periods I'm going to cover. First one is when I first started trading, really through the 80s into the late 90s. Markets were characterized by high volatility. They trended really well. Inflation was high. That's, of course, the high volatility and trending nature of the markets. Of course, interest rates were high in response. Now, another reason trends were smoother in those days were the orders were staggered, as they went basically from the floor traders who had news and price information first, to what I call the pro traders, the ones that could afford screens and so forth. And then there was the retail traders. And the retail traders would basically phone their broker to get the news. So if we sat around on non-farm payroll day, you could be sure that as soon as that number came out, the switchboard would be jammed. That's all the retail traders trying to get the information. So what you had effectively was the order flow was staggered. So it was a smooth flow of orders into the market. And also with retail traders, in my day, a lot of people looked at the newspaper the next day and did their order. Okay, so that way of orders coming into the markets made moves smoother. Okay, and now markets did change late 1990s through to 2008. Volatility was still pretty high, but trends became more noisy due to the internet, because everyone from the banks to the retail traders had the news and price information at the same time and could act on it at the same time. So very often what you're getting is the orders are all coming in the market together. Then there'd be no more buying or selling, and the price would whipsaw back. So that was a major change. And you also had added decimals, where on currency pairs, that extra decimals, they might not sound like they're important, but they were, because it meant you could trade smaller moves, and you had the rise of the high frequency trading systems. I've done separate videos on them, but they're lightning fast, okay, in terms of the way they can transact orders. They can do hundreds of orders in the blink of an eye. So they can take advantage of very, very small moves in the market. And they also pick on retail traders. They hunt out their stops. They try and get stop clusters by pushing the price short term towards where they think there's a stop cluster. And I've said it in other videos, a lot of people think their broker took them out the market. They've normally been taken out the market by high frequency traders. So markets are more choppy, let's say. The trends not so smooth as they were back in the 80s and 90s. Now, in terms of from 2008 through to the present, volatility is lower. Okay, trends more noisy again due to low inflation and central banks printing money. Now, the printing of money was supposed to push inflation up. but there's hardly any inflation in the world. Interest rates are low. If you've got low inflation, that really kills innovation and change in economies. I'll do a separate video on this because it's not easy to explain in just a few minutes. But today, I mean, the volatility is so much lower than when I first started trading. You see in the media like 100 or 200 pips is like an event. That used to happen every day when I first started trading. Probably the 80s, you could have currencies moving by 400 or 500 pips a day. That wasn't uncommon. I wish we had that sort of volatility today. So how has it changed technical trading? Well, if you look back into the 80s and 90s, you could use mechanical trading systems and they would work very, very well. We used to have a very simple one. It's called the trend identifier. I can't remember what we exactly called it, but all we did was look at a 9-day moving average, an 18-day moving average, and a 40-day, and wait for them all to be in the same direction. That would generate a buy or sell order. And if you did that on enough pairs, you could make decent money with it. That would never work today. Also, I think when I started trading, there were day traders who did make money. Obviously, the floor traders would be the prime example. Day traders today, retail day traders, don't make money. You will get obviously HFTs, high frequency traders, who do, but the retail trader who comes in and day trades and thinks he's going to win, you've got lots of random volatility, whipsaw action, and HFT traders operating. They just get destroyed. Trend following used to work, as I said, very well in the 80s. Long-term trend following now, from a pure technical perspective, I think is effectively gone. You need to know fundamentals or sentiment to make long-term trend following work, because the pullbacks within big trends are much bigger. Okay, I do feel that swing traders can still make very good money today from pure technical perspective, because you do get really exaggerated price spikes still, and you can go against them. Also, certain breakouts are really good. Tight range breakouts, from a tight range. They used to work back in the 80s, 90s. They still work today. Now, in terms of pattern trading, which everyone knows I think is ridiculous, it never worked in the 80s and 90s. Doesn't work today. It's never actually worked. The idea you can predict the market from twists and turns that went on before, said numerous occasions, like Gartley patterns and Fibonacci, complete nonsense. Okay, I think in terms of, if you want to be a technical trader today, swing trading is probably the preferred way of doing it from my perspective, and trading very simple breakouts or volatility spikes. I think with trend following longer term, you need to know the fundamentals and you need to know the sentiment. And in terms of day trading, just don't bother. The markets are just not going to give you any money unless you can spend a good few million developing a HFT system. So we can still make money, but the markets have definitely changed. Now, we do have low volatility, okay? I think that is going to start to increase. You're starting to see stimulus withdrawn by central banks. Rates are starting to go up, or interest rates, and that means we will shift to higher volatility, which will be great for us as Forex traders, because that will increase our profit potential. Right, that is the video for today. Thank you very much for watching me as usual. Take care and have a good day.